But it's not just gold and silver. I mean, I ran an article with a few charts earlier this week, which looked at pricing energy, base metals, basket of base metals, and also copper, pricing them in gold. And the answer is that these prices have fallen quite significantly in real terms. And it's the only reason they appear to be rising in fiat currency terms is because of the weakness of fiat currency. I mean, my comment on the war is I can't think of anything more stupid, really. I mean, why the hell are they doing this? I mean, the fact of the matter is that Iran has got the Hormuz Straits effectively closed. I mean, they haven't actually had to do anything. The insurance companies do the heavy lifting because they refuse to insure any ship that goes through. Because effectively this disrupts oil supplies, not only going through the Gulf, it will also, I mean, this is yet to come into play, but it will also disrupt oil supplies going through Suez because of the Houthis in Yemen. And not only that, but they're now bombing the pipeline from Baku in through Turkey, which apparently supplies 60% of Israel's oil. So this is very, very serious. It's very serious for the region. As far as markets are concerned, I'm surprised that bond yields around the world haven't shot up even more, because the inflationary implications, just put it simply, in language the macroeconomists understand, the inflationary implications are dire. Yeah. So far nobody really, until this happened, has really sort of thought that inflation was going to be a problem in 2026. Oh, yes, it is. And it's going to be a major problem. And without going into, destroying the macroeconomic approach to what happens to the purchasing power of a currency, just bear in mind that the last inflation spike happened at the start of Russia's special military operation against Ukraine. When we cut off our oil to Russia. I mean, this at the very least, if you like, is a signal to the dopey people in the investment management scene that we're in for another rerun of that at least. So where does that take bond yields? Well, I can tell you a hell of a lot higher than where they are at the moment. And it's just, the markets are slow to respond. I mean, it just amazes me. I mean, having been in markets for the last 60 years or so, I think nearly 60 years, I've seen volatility. This isn't volatility. This is just sort of, we don't know what's going on. And a little bit of markup, markdown, markup, markdown. What the hell's going on? A little bit of flight into the dollar. So flight into the dollar means gold goes down a little bit, etc. I mean, come on, where's the crisis? It's not there yet. We have yet to see it, Danny. And I think that
is there someone buying bonds in the back?
Energy disruptions rarely stay confined to oil markets. They quickly spill into the broader economy, fueling inflation across transportation, manufacturing, and consumer goods. The world saw a similar pattern when Russia's invasion of Ukraine disrupted energy supplies in 2022. Inflation surged globally as oil and gas prices soared. Today, analysts warn that the same cycle could repeat. Yet financial markets appear strangely calm. Bond yields have not surged as much as expected, and many investors seem to believe the disruption will remain temporary. But history suggests otherwise. When energy supply chains break down, the consequences can linger for years, quietly eroding the purchasing power of currencies around the world.
I don't think so, no. I think it's just there's a, if you like, a flight into what's perceived by the macroeconomic community to be safety, and safety is the dollar. Really? This is the question which I think is going to suddenly become, if you like, right at the front of everything. I don't see the dollar being a safe haven at all. I think it's become a lot more risky. And quite frankly, if you look at regime change, I mean, this is the word on everybody's, or the phrase on everybody's lips, regime change. If there's going to be a regime change, I tell you where it'll be. It'll be in America, because this is such a disaster for Trump. Will he survive a full term? I would question that. I mean, I don't know anything really about the procedures of getting rid of an incumbent president, but if there are procedures, I think he's at risk. I mean, look, the man's a bully, basically. He gets his way by, being effectively a bully. That's the way in which he runs things. But he chickens out. Bullies always chicken out. If you stand up to a bully, they chicken out. So, taco. Trump always chickens out. Now, you can't chicken out of this one, because what will happen, and I can, this is pretty certain. I mean, looking at the future is an uncertain business, but this is pretty certain within that context. If Trump tries to back out of this because it's just getting out of control for him, nobody likes it in America. I think 80% are against it or something. Did I read that somewhere?
It's a majority for sure. Yeah, it's a majority.
Yeah, a big majority. I mean, when it comes to the midterms and all the rest of it, I mean, this is death to Trump, really, or death to the Republicans. So when it comes to try and chicken out of this, what are the Iranians going to do? I think the Iranians are going to say, no, you are Satan. Get out of our area. And they will continue to bomb and shell American installations or American supporting nations, whatever, and particularly the military establishments around the Gulf. So I don't think this is something which Trump can stop. I really don't.
During geopolitical crises, investors traditionally seek refuge in safe haven assets. The U.S. dollar often benefits from these flows, strengthening as global capital rushes toward perceived stability. However, some analysts now question whether the dollar deserves that status. America faces mounting debt levels, persistent deficits, and rising geopolitical tensions. Meanwhile, several countries, including China and Russia, have gradually reduced their reliance on U.S. financial assets. If confidence in the dollar begins to weaken, global investors could look elsewhere for protection. Historically, that somewhere else has often been gold, a physical store of value that exists outside the traditional financial system and carries no counterparty risk.
Obviously not. But if I can make a comment about prolonged action against Iran, they haven't got the weapons. I mean, when I say they, I mean, America and Israel do not have sufficient ordnance to continue for more than a few days. I mean, it really is that serious. And if I was the Iranian leadership, I think I would say, well, okay, we're going to sit this one out for a bit. We'll send out our old-fashioned drones, which they're doing, the stuff which they made 8-10 years ago. They haven't hit us with the new stuff first. And if Trump is stupid enough to bring an aircraft carrier within range, I think you'll find that suddenly Iran has hypersonics. I mean, I think there's one missile which is said to travel at Mach 7.5. I mean, I don't know if that's true, but they've certainly got some very, very advanced weaponry. And I would think that when it comes to naval assets, they better stay a long way away, because if they come within range, I think they're sunk. It's really that serious. There will be mining. I'm sure there will be mining the Hormuz Straits. You've also got the straits at the bottom end of the Red Sea. Nobody's talking about that yet. These things are going to continue. I mean, you don't, kick a hornet's nest without everybody getting stung. And that's basically what's going on. And the markets are not prepared for it. And as I say, we're in a situation where the purchasing power of the dollar is already going down. I mean, don't forget that on February the 9th, China turned around and said to its banks and its institutions who are licensed to hold US treasuries, sell them. Why was that? China, I think, made its own assessment of as to where this is going. I can't see that European institutions are interested in buying US Treasury debt. All that leaves, if you like, are hedge funds operating through the Cayman Islands, special purpose vehicles taking European investment money out of Luxembourg and also London. But I mean, other than that, I don't think anyone wants to buy the stuff anymore. This is actually, it's like a debt trap for the US. And the signs are that the US economy isn't exactly, I mean, it may be stagnating. I mean, you just don't believe any government statistics because you can't measure economic progress, really. You can measure activity to an extent by tracking credit, but that doesn't necessarily tell you how that credit is really being deployed, which is really what you want to know. If you've got an economy which isn't growing in the States in real terms, and certainly this is the case, if you take out the budget deficit out of GDP, the US economy is actually contracting. The only thing that creates the illusion of growth is government excess spending. Now, that's not a good thing. It's been like that for the last couple of years. And I think people will wake up to this. And so what should the yield be on a US Treasury? I mean, the answer is far higher than it is at the moment. Well, there is an extra factor in this. I mean, I think that, Trump has been not as stupid as the Europeans when it comes to energy policy. I mean, they have just been off the scale stupid about energy. I mean, Germany's killed its own output. The car manufacturers are struggling. They've got a cost base which is completely uncompetitive compared with China. You've also got, when they cut off the oil and gas and things from Russia, combine that with this sort of socialistic mania for zero carbon output by whenever, and banning the production of motor cars, with driven by diesel or petrol, all this sort of stuff, and emphasizing, subsidizing, if you like, at taxpayers' expense, solar farms, windmills, all this sort of stuff. I mean, it's just absolutely crazy. The only country which has got a decent supply of electricity is France, because it had an extensive nuclear program. And the amazing thing is that Brussels turns around in this crisis here and suddenly goes to President Putin and says, we'd like to buy some of your energy. And what does Putin say? He says, you're an unreliable customer. We've got better customers in the East. So piss off. I mean, it's just absolutely amazing. And so Europe is in a real bind on energy. It is crazy. And this has just brought forward that reality.
While Western markets focus on short-term volatility, China appears to be taking a longer strategic view. Over the past decade, Chinese institutions and households have steadily increased their exposure to precious metals. Chinese banks even allow ordinary savers to open gold accumulation accounts with small monthly contributions. This policy encourages citizens to convert part of their savings into physical gold. Considering that Chinese households collectively save trillions of dollars each year, even a small shift toward precious metals could significantly influence global demand. At the same time, China has restricted exports of certain critical minerals, including silver, tightening supply in international markets.
Yeah, I mean, basically, China and Russia, I think, are being very sensible. Anything they're doing is well below the radar. They're just keeping out of the headlines. And it's the old Chinese approach, just let the enemy make the mistakes. What's wrong with that? I mean, to be fair, China has become a bit more proactive in the last year in terms of responding to what the enemy, if you like, if we can call the United States China's enemy, has been doing. And as far as our audience is concerned, this particularly hit silver because China was an exporter of silver, which kept prices down. And then the United States comes along and says, this is a critical mineral, so we've got to build our reserves. So what does China do? It stops exporting silver because it wasn't going to go and beef up American silver reserves. And that decision was taken at about the same time as the rare earths restrictions back in late September. And within 2 weeks, there was a liquidity crisis on the LBMA on October the 6th, 7th, 8th, 9th. And on the 10th, I think they suspended trading for an hour and a half to try and sort out the mess. And now in COMEX, I mean, the thing that's amazing is open interest is now the lowest it has been for 20 years, over 20 years. This is basically, I think the establishment just doesn't want this contract. It's trying to get out of the contract because there's no liquidity in it. They're being asked to deliver. They've got far too much paper covering too little stock. Who wants to play? It's a guaranteed loss. And if you look at what's going on in gold, I mean, the demand for gold is continuing. It's orderly. I understand. I mean, there was a posting on X, but it was an authoritative posting that both the ICBC, the largest of the Chinese banks, and also the agricultural bank, have no gold bars in stock. So you can't buy any gold bars off them. So that shows really that any loose stuff, and if you look at the physical reserves in the SGE and the Shanghai Futures Exchange, I mean, those are very, very low in silver. Basically anything that's available is getting absorbed.
Why is gold getting sold off?
Well, I mean, basically, it's these stupid macro people. I mean, they think the safe haven is the dollar. That's why. And if you go back, I mean, they did exactly the same thing on the Lehman crisis, because when that one broke, gold fell from $1,000 down to $680 in a matter of, I don't know, a week or two. While markets crashed, but afterwards it went up to 1920, I think, by about the 11th, 2011. So they're just doing that playbook. I mean, they sort of think that there are loads of speculators who own gold. No, they don't. I mean, the reason that you can mark it down and mark silver up and down, whatever, is that there's nobody challenging you. The only problem is that if you mark it down, it leaks out into Asia. I mean, the great saving grace, I think, as far as silver prices in the West is concerned, is that if you're going to import silver into China, you have to pay a 13% VAT charge. So 13% plus maybe 2% to ship the whole stuff over there and all the rest of it means you've got to have at least 15% clear before you can do the arbitrage, buying on COMEX or buying in London and shipping it out to China. Gold less so. I think, basically there the demand is institutional mainly, coupled now with an increasing realization in the Chinese public that they ought to have some gold. I mean, it's worth pointing out that the big Chinese banks allow you to run a gold accumulation account alongside your deposit account. Now, that gold accumulation account, you can start for as little as 500 yuan. Which is what, $70, $80 or something. I mean, it's not a lot. The point here is that household savings in China amount to roughly 30% of China's GDP, which translates into dollars at around about $5 to $6 trillion every year being saved by households who aren't putting it into property anymore, maybe find that the equity market is something they don't understand, so they won't play. And certainly if you look at the way the Shanghai stock exchanges performed, I mean, it hasn't followed the Western pattern at all. Only recently has there been a bit of a spurt. Or alternatively, you put it onto into bank deposits, and the banks have been creative. They're saying, okay, we will try and enhance the yield if you, let us say, lock it up for 3 years, sort of thing. But the People's Bank of China has been reducing its reference rates. So where do you put your 5 to 6 trillion? Well, you put it in something which you can understand and is rising, and that's gold accumulation accounts. So the demand, I think, is going to continue, and it looks to me as if the progression of gold is actually, it's not showing signs, if you like, of being overblown, overbought, however you like to describe it. You haven't got that speculative activity, if you like, in either gold or silver. Maybe silver was the case to an extent in China. I mean, obviously we saw a little bit of that when it ran up to $120 odd an ounce. But I think that's probably mainly digested now. And the reason that we have, I mean, I think last night in China, silver closed about $99, $98, $99 equivalent, whereas over here we were looking at something like 84, 5 at the time. Yeah, I mean, it's the VAT hurdle, I think, which means that the arbitrage isn't really occurring. But, there's no doubt that the pricing has moved away from us and it's gone into China. So you go and bet on COMEX or in London. I mean, you may as well go and bet on the horses.
These policy changes are already reshaping precious metals trading. Silver inventories in major exchanges have dropped dramatically in recent years, while open interest in futures markets has fallen to levels not seen in decades. Such conditions suggest traders may be losing confidence in paper-based contracts that rely on physical delivery. Meanwhile, demand for gold remains steady, particularly across Asia. When gold prices temporarily fall due to speculative trading in Western markets, buyers in Asia often step in quickly, absorbing available supply. This pattern indicates a shift in global price discovery, with physical demand playing an increasingly important role in determining long-term market direction.
But it's not just gold and silver. I mean, I ran an article with a few charts earlier this week, which looked at pricing energy, base metals, basket of base metals, and also copper, pricing them in gold. And the answer is that these prices have fallen quite significantly in real terms. And it's the only reason they appear to be rising in fiat currency terms is because of the weakness of fiat currencies in terms of their purchasing power. So we've got a situation where I think you could easily see these base metals, energy, and all of these things, the whole of the commodity complex, including food, incidentally, agri-products, rising in fiat currency prices very substantially over the rest of this year. And, I can see inflation at the end of this year maybe hitting 20+%, maybe even more. And markets are just completely unaware of this risk, which is an extraordinary situation, Danny. I mean, you think, wake up. It is really very serious. And not only that, but I understand that the strategic petroleum reserve is actually rather low. It's below where it should, the minimum level where it should be. China has stockpiled a lot. So I think the oil supply problem is a slow fuse as far as China is concerned, but it's a considerably more rapid fuse as far as America is concerned.
Right. Here's a chart of the SPR, and you're right. It's been pretty depleted over the Biden years at the very least.
Yep.
So we had a low here in 2023, and we're still well off the highs that we were back in the 2010s. This is the same level of reserve that we have that we had in 1984. Yeah.
That's not good, is it?
No, not at all.
The one thing about America is that you are the largest producer of oil, which is fantastic. So you've got a very, very good domestic supply. So while the strategic reserve is low, I don't see it as being an ultimate catastrophe. But inevitably, you're going to find that gas prices and all the rest of it are going to be a lot higher. And going into the midterms, do you really want to see that? I don't think so.
Looking ahead, some analysts warn that the world may be entering a new commodity cycle. If geopolitical tensions disrupt supply chains while global currencies continue losing purchasing power, prices for energy, metals, and even food could rise sharply in the coming years. Historically, periods of currency weakness and geopolitical instability have coincided with major bull markets in commodities. Investors may already be positioning for this possibility. Gold demand continues to rise globally, and strategic resource competition between major powers is intensifying. Whether markets fully recognize it yet or not, the foundations for a new inflationary era may already be forming beneath the surface.